Hello and welcome to this live broadcast on CGTN. I am Chengxi in Beijing. Today we're joined by two finance experts to talk about policy resilience in a changing world. This dialogue is held in collaboration with the China International Capital Corporation, or CICC. Now, financial crises, international conflicts, the COVID-19 pandemic, and climate change have all posed significant challenge to the world economy. How should countries enhance their resilience and realize stable growth, but also to reach for longer-term goals, such as a transition towards low-carbon economy and eventually carbon neutrality? To answer these questions, we're joined by two distinguished guests. We have Professor Markus Brunemeyer from Princeton University. His research focuses on international financial markets, monetary theory, and also macroeconomics. We also have Dr. Peng Wensheng, the chief economist of CICC. He is also the dean of the CICC Global Institute, a policy think tank and research institute covering the economy, green transition, and technology. Thank you very much for joining the program. Let's just dive into it. Professor Brunemeyer, let me start with you. The keyword in the title of your recent book, which is right here, The Resilient Society, and also the title of today's dialogue is resilience. So can you elaborate on what does it mean in terms of policymaking, and how is it different from the standard policy frameworks in advanced economies today?
Thanks a lot for having me. It's a pleasure to be with you, and for the audience for coming here. So resilience is about bouncing back, and it's different from avoiding risk. So if you want to avoid risk, essentially you don't take certain opportunities. Resilience means you must take certain risky strategies, but then you have to decide, is the strategy come with resilience or without resilience? So rather than avoid risk or take on risk, you should take on risk which comes with resilience, and avoid risk which comes without resilience. So the resilience is the decisive criterion to look for. It's also different from a policy where, say, I want to go for a robust approach. Everything has to be fit for the worst outcome. While here in resilience said, okay, we experiment a little bit, we take opportunities, we take chances, but we make sure we take only risk from which we can bounce back easily.
So what you're advocating for is that we shouldn't be afraid to take some risks, so it allows us to bounce back better. So how does regional disparity come into play? For example, are bigger countries with a more complete economic categories more resilient to what risks?
Actually, so you have a better way to diversify across regions, and it could also be that you experiment across regions. So some region is trying out something, and then it works well, and then the other regions are copying it. Well, if it doesn't work out so well, the other regions will not copy it. So having some heterogeneity and differences and regional differences, and allowing regions to experiment on their own and others to copy what is successful, helps the whole country then as a whole.
So compared to more traditional thinking where we want to avoid risk as much as possible, we encourage taking some risks. So we need to know where the tipping point is. Before we hit the point of no return, we use policy incentives for the economy to bounce back, right? So one question is, how do we know where the tipping point is? A miscalculation could be catastrophic here.
That's true. So you mentioned already there are some resilience killers, like traps. So when you hit the trap, you're stuck. You can't bounce back from it. And tipping points are even worse. When you hit the tipping point, the situation gets worse and worse. You get in an adverse feedback loop and spiral, essentially. The whole situation spirals out of control. So it's really paramount not to take risks which lead to potential tipping points. And the art is essentially to figure out where this tipping point is. And normally, you can only figure out where exactly the tipping point is when you get closer to it. So you need flexibility and agility to readjust your strategy such that if you see as you get closer to a tipping point, you can turn around or you can make sure that it bounces back before the tipping point. But there is always a residual risk. I have to admit that you never know 100% where the tipping point is. But in many policy decisions, in many firm decisions, we know where the danger zones are, and we should stay away from them. So if the risk-taking means you take on risks which might end up in a tipping point or might end up in a trap, don't take on this type of risks. But if the risk means we might get the setback for a while, but we will be able, and we have set up our system in such a way that we can actually readjust and be agile and adapt in such a way that it can bounce back, then we should take on this risk, because risk-taking means you also make sure you take the opportunities and not only avoiding risk, but also taking the opportunities and grow further in your economic world.
Now, at the end of the day, up and down fluctuations is what really economies are about, right? So, Dr. Peng, you've written extensively on financial cycles and monetary policy. So my question is, do you think our major economies from China to the US to the Eurozone now in different phases of their respective financial cycles, and what really could this mean?
We are concerned with volatilities or cyclical movements in the economy. GDP growth, inflation, and some financial movements. And financial cycles describe the so-called pro-cyclical behavior in the economy. And that pro-cyclical behavior is related to the role of collateral of land for bank lending. And therefore, we have observed, for example, the interactions between land value and bank lending. And therefore, a typical financial cycle lasts for 15 to 20 years, compared with a typical business cycle that lasts no more than 10 years. Now, major economies, China, US, Japan, Europe, have gone through different financial cycles. And at this point, we are in a downturn of a financial cycle. We are experiencing downward pressure on the property prices, bank credit, whereas the U.S. has been experiencing an upward phase in the past 10 years. That was actually after 5 years of downward adjustment following the subprime crisis in 2008. So we have this divergent behavior in financial cycle, and that is shown in macroeconomic variables. For example, U.S. is currently under inflationary pressure or persistent inflationary pressure. China is under disinflation or downward pressure in prices because we are, in a way, experience a weak aggregate demand. So this divergence in financial conditions, in macroeconomic conditions, are also shown in the differences in macroeconomic policies. For example, the U.S., the central bank, Federal Reserve, has been tightening, and the market has been, expecting some easing, but it seems coming late, right? Whereas in China, the central bank has been easing monetary policy. So that's.
Yes, Professor, what do you think of this dynamic right here?
Yeah, so you have essentially some resilience on the US economy. So it's bouncing back after the COVID crisis much more strongly than we thought. And inflation is also coming back and is now coming down. And that's why the Federal Reserve has heightened interest rates. While the problems in China are slightly different, it's related to the real estate situation and collateral complications, which lead to a downward spiral potentially. Some potential tipping points one has to avoid in these circumstances. And you see different parts of the world reacting differently, and that also leads to different interest rates in different parts of the world. And that typically when you have very divergent interest rates, it also affects the exchange rate between the two currencies. And that's one has to watch an eye for, because you don't want to have any rapid changes in the exchange rate. You want to have a more smooth transition in the exchange rate as well.
Now you mentioned the exchange rate. As we all know, monetary policy often have spillovers beyond borders. So as policies diverge among countries with different growth rates and inflation levels, how do you think policymakers and also investors should make sense of this dynamic and navigate through it and even tackle it? Can we start with you?
Yeah, so the most important thing is to keep this in mind, what's going on at the moment for investors. They have to keep them cool head and don't overreact. Sometimes what leads to less stable developments, less resilient developments is people overreact to circumstances, and then it can be self-fulfilling and make the situation even worse than it was initially. So from a policy-making perspective, it's clear communication, I think, is very important to show a path forward and how this whole situation will be managed, and will lead back to an equilibrium situation. That's very, very important. And that makes the whole bouncing back also more likely if there's a clear and a coordinated path forward. So it's important that different policymakers coordinate and come with a coherent communication strategy for the investor community, and the investor community can then coordinate on this communication strategy in order to stabilize and make sure that the whole economy stays, global economy stays resilient.
Dr. Peng, what are your thoughts on the challenges in this imbalance dynamic?
There are three ways of dealing with shocks in the economy. One is exchange rate flexibility. The other is some kind of buffer, like international reserves or safe assets. And the third one is actually policy, administrative policy, like capital controls, etc. And these three elements, there's some degree of trade-off. And experience have shown us that exchange rate flexibility is not enough, or there's a limit to that for most of the countries. And therefore, there seems a consensus that there's a rule for safe assets or international reserves to deal with external shocks. And then, of course, for some other countries, you may add some administrative measures in terms of controlling inflows or outflows of capital and financial flows. And in our case, in China case, China is a big country, right? A big country is like a big ship, right? Is in better position to deal with volatilities in the market and in the economy. And we have seen increased degree of flexibility in the renminbi exchange rate, and we have also accumulated a large amount of international reserves. Although the size has declined somewhat, but still is the largest in the world. And also we, in terms of resilience, we have policy tools at a disposal. When there is a need to increase or to tighten controls on cross-border flows. So overall, I think in terms of international spillovers, I would say we have the tools that will enhance our resilience. But I agree that in the international monetary system, there is a challenge that in terms of supply of safe assets now is not diversified enough, very much imbalanced. Most of the safe assets are provided by the US or developed countries. So that works against emerging and developed countries and emerging and developing countries. So I guess that's a big challenge for the improvement and innovation of the international monetary system. May I add one more thing, that safe assets, in a way, is a construct. Right? It reflects policy measures, policy thinking. So I think international coordination, some kind of politics probably is inevitable in terms of increased supply of safe assets in the international monetary system.
We are in a world of uncertainties, right, Dr. Peng? How safe would you say are the conventional safe assets of today?
Well, that's what I mean is this concept of safe assets. First of all, they evolve over time, right? For example, previously, probably most people will think U.S. treasuries are safe assets, right? Absolutely safe assets. But now, following the geopolitics, international financial sanctions by different countries, then there's a question whether this definition of safe assets will evolve along with changes in the economic, financial, and even geopolitical conditions globally.
Okay.
Professor, your thoughts on this? Because the U.S. Treasury and U.S. dollar has long been categorized as an absolute safe asset. Many say it possesses what's called exorbitant privilege for being the dominant world reserve currency. And what are the implications of this, and also for economies that cannot issue their own internationally accepted safe assets?
Yes, so first let me say what a safe asset is. In my view, a safe asset is like a good friend. There's this saying, a good friend is a good friend indeed. So somebody, if you're in need, that's a good friend. So a safe asset is an asset which maintains its value when you have individually a personal crisis, but also when there's a global crisis. So whenever there's a global crisis, it appreciates in value. That's essentially a safe asset. And a classic safe asset is the US Treasury. I mean, that has this safe asset status. And I agree that, there might be a limited supply of safe assets, but I think that's one of the issues. But the bigger issue is essentially, is the safe asset asymmetrically supplied or symmetrically supplied across the globe? And whenever we go in a financial crisis, then there are distortions in the global system. So because the US Treasury is gaining in value while other government bonds losing in value. And that leads to the global distortions. And that's what we have to work on. That requires some coordination on it. But what's also essential for a safe asset is that it can be freely traded. So there's an open current account. So you can easily buy and sell at the global level from the safe asset. I still think sanctions make the US dollar for certain countries less attractive good friend. But that's only if you're subject to sanctions. So to the extent, you follow the international community and all this, I don't think it's a big threat. I think it's still the most liquid and the most valuable asset we have out there. We can convert very easily into some other assets or some other goods if you need to. And ideally, we would like to have a world where the safe asset is provided more symmetrically across the world, and that it would mean whenever we go in a crisis, it doesn't lead to these distortions. And that's essentially something we should work on in order to achieve this in the long run.
May I add one point here? China is the second largest economy in the world now, and also second largest financial market in a way. So I think going forward, it's natural that China will become, a big role, a big part of the supply of safe assets, and that would involve, for example, allow a higher degree of cross-border flows, and particularly for the foreign investors, institutional investors, and for example, foreign central banks, to acquire and hold the Chinese treasury bond. I think so. So that is probably one direction for the future evolution of the safe assets going forward.
What measures should be further taken to really enhance that process, in your opinion?
I think we should broaden and deepen our financial market broadly, not only in terms of government bonds, but also, for example, equity markets and credit market.
Professor Brunnermeier, let me follow up on one of the points you made. You've said that in your assessment, the U.S. has bounced back pretty decently after the COVID-19 pandemic. So it showed what would you describe as resilience in their economic policy making. So what risk did they take that allowed them to realize that this resilience bounced back, in your opinion?
I mean, there's certain steps. So first, there was a huge investment in special vaccine development. So it was huge amounts of money poured into new mRNA vaccine developments. That helped the economy to bounce back much more easily. And second, there was a huge fiscal stimulus giving money to the hands of the citizens in order to spend and get back to circumstances. And then there was the flexibility of the labor market, I would say. So the huge unemployment happened during the COVID crisis, and then actually unemployment is at record low. So this flexibility in the labor market to restructure, to find new ways working from home, to integrate this in the labor market, and bringing new people into the labor market, that actually was a big strength. What helped essentially the U.S. economy be resilient and bounce back. All of these combinations, all of these aspects together, made a difference.
Thank you. Now, seismic changes are happening in the world economy and financial markets, but we're also witnessing another transition which is of great importance and of longer term, and that is the transition towards low-carbon economy and eventually carbon neutrality. So let's move on to part 2 of our discussion, the green transition. So let me start with you, Dr. Peng. Now, China has committed to reach carbon peak by 2030 and carbon neutrality by 2060. So what are the major challenges in this process, and what do you think China's role can be?
The general challenge for green transition is what in economics what we call a negative externality of carbon emission. Basically, carbon emissions benefit the individual entity that emit carbon, but harms the whole society in terms of climate change. Right? And because of that negative spillover, there is not enough incentive by market forces to reduce the use of fossil fuel and emissions of carbon, and therefore you need a government policy intervention. And one way of this intervention is to use a carbon tax or some kind of carbon trading system, carbon pricing, to increase the cost of fossil fuel. Right? So that's one way, and the European Union has been, in a way, leading that approach in the past 20, 30 years. Now, by our research, the CICC Global Institute and our research department, we have been arguing that there is another approach on the supply side of the green energy. That is, how do we stimulate innovation in green technology and green industry investment? Right? We also have this externality, a positive externality. That is, innovation benefits society, but the input, the R&D is borne by individual entities. So there is not, by market forces, there's not enough R&D at the aggregate level. And therefore, we need also public policy intervention. That is, for example, fiscal subsidies or some other kind of support to innovation, to industrial investment in this new area, new technology. And in a way, that's the approach that has been taken by China in the past 20 to 30 years. Now, our research shows that at this point, if we compare the achievements of these two approaches, right, in terms of the green premium, with the green technology cost is lower than fossil fuel cost, and also in terms of the increase in the new energy capacity. If we compare, for example, China with the European Union, because China and the European Union are of similar size in terms of economy. We have been growing much, much faster in terms of new energy capacity. Right? So, and to the extent that green sector, green industry in China has been leading the world. For example, EVs, solar power, wind power equipment. So my, our view is that China's approach has been, in a way, a successful approach, and we have been providing equipment, providing resources for green transition at a low cost to the global economy. Right? Now, the challenge is that green energy is basically manufacturing. Manufacturing is a tradable goods. Right? So it's different from the traditional fossil fuel. Traditional fossil fuel is also tradable goods, but they cannot scale up. If you have certain amount of reserve, oil reserve, you only have that amount, right? But manufacturing can be, scaled up. So and that's our cost advantage. We have a much bigger scale in terms of manufacturing. And on the positive side, that means that we have been contributing to global transition, green transition, in a very significant way. On the other hand, it has been inviting trade protectionism because some other countries, for example, US and European Union, are concerned that this new sector, this new industry, is being led by China, and it may be, exerting a kind of crowding out or squeezing effect on other parts, particularly US and Europe. So I think for the global community, that's a challenge. For the economics profession, also a challenge. There are two ways of correcting externalities. Right? One way is on the demand side, carbon pricing. The other way is on the supply side, on promoting technology progress. In theory, both ways are appropriate, ideal solutions. Right? But in practice, we have these differences because different governments have taken different approaches.
Your thoughts on this, Professor? Because
yes,
at the end of the day, it makes the market inefficient, right? Because of this supply chain readjustment away from the most cost-effective options in China. So how big of a challenge is that towards global green transition?
Yeah, I think the green transition, it's full with externalities. It's important that we face the challenges and save the planet. I agree with that. There are essentially two ways forward. One is to slow down GDP growth and produce less and reduce emissions this way. And the other way is to go through innovation. And that's essentially also what is proposed here. So the innovation, I think, is the right way to do that. And then the question is, what do you subsidize? Do you subsidize the innovation process, or do you subsidize the scaling in the production process? And I would say the subsidy should be on the innovation process. Even though there's a challenge, the government doesn't really know what innovation to promote and which one to cut off. It's, should we go for hydrogen or electricity cars? Who should figure this out, the government, or should this be done by the industry who is closer to the problem? So the second problem is, do we want to have one big push in one direction, or do we want to let 1,000 flowers bloom, in a sense that we like 1,000 different innovations all over the place, and we just do some blanket subsidy, in a sense, in the innovation space. On the production space, I'm less clear that we should subsidize at big scale, because that distorts the whole international trading system, because you would like to have innovation going on in China, but also innovation going in the US and Europe. And if you flood the market with cheaply produced Chinese goods because they're subsidized, you cut off the innovation in Europe and the US. And I think it might be beneficial from a trade perspective for China, but it is not beneficial for the global community, and it's not beneficial for the green transition we are facing as a global community. At the end, we all sit in the same boat in this dimension. We don't want the climate change will take over and destroys crops all over the world and leads to huge migration movements, whatever. So that's essentially, I think, we should like to promote innovation across the globe in different regions. And, US with the Inflation Reduction Act did a lot of subsidies on the innovation space. I think the innovation should happen and should be subsidized, innovation space, but then the production side, that should be left up to the market, and the market forces play out, who is more productive, who is less productive. And if it's highly subsidized, you will see countermeasures, and these countermeasures in form of tariffs, they will destroy the international world global trading system, and that will hurt all of us if we destroy it indirectly or directly.
I remember raising this question to the spokesman of China's Ministry of Commerce, and he said that his counter-argument is that the world actually does not have enough new energy products. He cites the International Energy Agency, which says that by 2030, new energy car sales should reach 45 million to fit our goal of reaching carbon neutrality in the future. And frankly, our production capacity in the world right now overall is still lagging behind. So how do we balance that is an ongoing process. But Dr. Peng, Professor Brunnermeier mentioned the encouragement or promotion of upstream innovation in terms of green products. So in your observation, how is China encouraging green innovation in this country from the upstream?
I think our research shows that the government support to innovation certainly plays a role, but in terms of scale up, the decline in the cost of production mainly reflects the scaling. This is not only is the case not only in the green sector, actually in most other manufacturing sector. Without technology barrier, almost anything that is produced in China will have a lower cost than most other countries. Why? I think in my view, the whole economics profession has not paid enough attention to the role of scale. We tend to treat large and small economies in the same way, right? We treat, for example, in the international market, everybody is price taken, but if in fact, in many cases, it may not. So I think this is one thing that the global community. I agree with Marx that this is a global community. This is our common cause, right? But I think there is an issue of how to balance between the large and long during growth in the demand for green technology, green equipment, and the real world balance between different countries' experiences. Right? But at this point, as I said, seems that other countries are moving into the supply side, the direction of the supply side actions. For example, the U.S. Inflation Reduction Act basically is providing subsidies to EV sector, to the new energy sector, right? Not only innovation, but production, right? And in the European Union, same thing. I forgot the exact name, but it's similar to the U.S. Inflation Act. So I think this is a question that should be raised to the global community. How should we tackle these balances, from different aspects for the common good of green transition?
Professor Brunnemeier, in the era of slower growth for the world economy, the transition towards low carbon may become more difficult. Old policy paradigms might no longer work. Pushbacks could be expected. So do you think we need more resilience in transitional policy? We're circling back to that concept now. And if so, what could such policy look like?
Yeah, so essentially a transition is a difference from a shock. Now, a shock happens in one period, and then it's over, and then you say, okay, how can I bounce back after the shock? A transition is a long-lasting, is a shift instead of a shock. And for this, we need different policy instruments. We need some supporting measures by things, but we also have to make sure we keep the flexibility and adaptability. So we don't want strict, rigid rules up front specified now, because we don't really know how things will play out. And we want to have a system which adjusts as we go through the transition phase. And importantly, we want to make the right speed of transition. So if you go very fast, you have to throw a lot of machines and a lot of existing capital goods away, and that actually is very, very inefficient. If you go too slow, then actually what will happen, the firms will use still old technology rather than the new technology. But overall, I would say the emphasis should be on the innovation side. Scaling up is important too, but the industry will do that on its own. The innovation, where I have this double externality, as was pointed out, that on the one hand, you create positive externalities from innovating, so that's what you want to promote, and you want to avoid negative externalities from the environmental side. So there's a double externality on the innovation, on the green innovation side, and that's where we should actually zoom in on the government action.
Dr. Peng, are there effective financial tools that can balance between transition and growth in China and around the world?
Well, there are two ways to promote green transition in terms of financial side. One is bank credit. That bank credit can be used to support production, scaling up. But also we need to support innovation. And innovation, we don't know which direction before, right? So we need, in a way, the equity market or stock market investors to choose or to make a decision or to finance which technology path. And the equity market is in a way much better than bank credit because there's a better match between risk and return. So in China, bank credit has played a very important role in terms of supporting manufacturing of green transition equipment. And we have seen also some progress in terms of the equity market on innovation side. But I think we haven't seen probably not enough progress in terms of risk and return balance in terms of promoting innovation. So I think there not only government support, but probably more important, we should have a big role for the equity market in this process.
Now, here's a last question for both of you. For the final question, let's zoom out a bit and look at monetary policy and the green transition from another angle, and which is artificial intelligence, which holds the promise of helping humans tackle entrenched problems in complete new ways. So, Professor, what do you make of the role of AI in terms of policymaking?
Yeah, so I think AI opens up many opportunities, but it also potentially creates some danger. So like any innovation, it has positive and negative aspects. When we invented dynamite, you can build tunnels, but you also can build bombs, essentially. And so new technologies are amplifiers, and we have to harness and figure out what are the good things and how can we develop and design a system that the good things will be exploited and the bad things and the risky things are avoided. And AI opens up many, many opportunities and a lot of efficiency gains and also better ways to communicate. And this will actually help us in many dimensions, also on the green transition side, but also in the life sciences and health dimensions. I think there are big opportunities there to expand our lifespan and so forth.
Yes.
So I think that's another shift we will experience. So there's a transition phase going from this innovation as we move there, and we have to avoid the bad outcomes and make it resilient in a sense. So there will be temporary setbacks from experimenting with these new technologies, these new AI technologies, and then we have to adapt and adjust such that we can bounce back and avoid essentially tipping points where the situation spirals out of control.
What would you think could be the first things in policy making that could be relegated to an AI algorithm in the future?
I don't think so. If I just look at self-driving cars, so we made a lot of progress on the self-driving cars, but it took way longer than we anticipated it will take. And so that's one experience we have. I don't think it will replace humans so easily. It will complement humans' activity. So I don't think we can totally outsource something to an AI robot. It will be a complement to that, but I can see a lot of advantages in the healthcare space, looking through X-ray pictures and many, many other dimensions. I think there's huge efficiency gains in that space.
Dr. Peng, CICC Global Institute has done extensive research into AI. Can you share some of your findings?
Yes, AI is a general purpose technology, and it's clearly going to have a major impact on productivity, on the social and economic aspects. So CICC Global Institute and together with CICC Research Department, we have been doing research mainly on the social and economic aspects, including financial side of AI breakthroughs or AI progress. We have been doing this report, and we are going to issue this report in early July. I can disclose at this point that the name of the report is AI Economics. So we focus on economic and social and public policy side of AI development.
We're surely looking forward to that publication. Thank you very much, gentlemen, for sharing your insights and thoughts on international financial markets, the green transition, and artificial intelligence. We look forward to our next discussion. I'm Yang Chengxi in Beijing. This is the end of this live broadcast. I'll see you in the next one.